If you look at the long arc of history and mostly US venture, we have seen it change and shapeshift every decade or every 15 years. During 1990s, you were seeing much smaller firms because the size of the prize was limited. Then the dot-com boom happened. You saw the size of the prize increase, but you saw the number of outcomes also increase. And that led to a Cambrian explosion of ideas of venture firms and a belief that venture has to be a diversified strategy. Then I think when you enter 2013, 14 to where we are now, there has been a market shift in the kind of venture firms which have become successful. So it is not just good enough to be in the right companies. Those right companies have to be rightly sized to match your outcome as well. Over the last decade, with the most successful firms, their top 5 positions, they would probably make up as much as 30-40% of their cost now.
When your fund size grows from, let's say, 200 mil to, let's say, a 500 mil, writing the seed check doesn't give you a return on the fund because you will get diluted significantly till, let's say, an exit. Today, if you look at any early stage fund, generally they're going to reserve 60 to 70% of their corpus because essentially that's where you're supposed to make more and more value, right? So now that decision making or evaluation structure has to be repeated again and again for the same set of companies.
There's 3 broad strategies. One is the green oaks you're highly concentrated. You're sector focused, stage focused. Right? The expertise they're building seems to be a lot more about one sector or at one stage. Other strategies may be a core 2 where there is no sector stage per se. They're happy to do a seed, they can come to growth, they can do public. So the market cycles between stages or sectors doesn't affect. The third is what Tushar earlier talked about, more private equity style. I mean, let's take GC for example. I'm seeing a lot more of that activity in India where you're owning 70-80% of a company, like platform creation, so to say.
You start with 12 to 15 names in every fund cycle. You divide those names into 3 buckets. One is like the net new public exposure you are taking. One is the mid-market growth equity portfolio that you are building, companies between $200 to $500 million of valuation. And third is the $50 to $100 million sort of entry size checks. So for the bottom third bucket, the position sizing will probably be like 20% of fund of cost for you. For the middle bucket, it's probably going to be where I'm going to deploy bulk of my capital, like 50-60% of my capital. And the other 40% or 30% is going to be in the publics. The hope is going to be that during each fund holding period, companies will move from bucket number 2 to bucket number 1, which is like move from mid-growth to publics. And then, you run the playbook again from the next fund, where you are investing behind the same companies that are known knowns and the companies that you like over and over again. And you keep concentrating capital, not just in a single fund, but across funds.
Look at a B2B marketplace. Now they deal with, let's say, ROCE calculations, working capital calculations. While somebody might say logistics is about network effects and building like a mesh network, there is a core value because it is essentially a B2B sale that's happening. So having that level of depth and understanding your portfolio or the companies you're evaluating actually function on a day-to-day or at least on a week-to-week basis, that gives you that expertise to also evaluate companies in other sectors.
Another episode of Moonshot Projects. Tushar, Pranjal, thanks for making it. But I think we were trying to coordinate it for a long time. Finally happy to do this. Yeah, so this podcast ka goal is very simple. Most of us, during our catch up, we keep brainstorming about venture as a product. Apart from analyzing all the SaaS, consumer, fintech businesses and other businesses invest in, how is venture evolving has been a very, very interesting thought to dabble with. So I spend a lot of time analyzing interesting investors, but not so much time thinking through interesting funds. I know both of you have spent a lot of time thinking about this. So, but we'll get on with a quick intro for the guest. Although I know both of you, I think Pranjal, Tushar, you guys are meeting for the first time, right? So it'll be
yes, that's right.
Interesting for an intro. So maybe Pranjal, if you get started with you and then we on to Tushar, it'll be super helpful.
Yeah, so this is Pranjal. I work at Creagis. So we're a growth stage equity firm. We typically focus on 20 to 50 mil checks, primarily focused on either Indian businesses or Indian founders building for the world. And it's a sort of sector agnostic fund, right? But typically focus on the series B, C, and D. And over here, I primarily cover B2B, I cover fintech, logistics, also cover healthcare, and a bit of consumer tech as well. So all your travel, content, social media, those kind of businesses. Been here like 3.5 years. Before this, worked at Elevation Capital. So again, seed stage investing. And again, there covered consumer tech. Prior to that, worked at Google, so a corporate VC. Again, covered consumer tech, fintech, and then worked in banking as well around 3 years before that. And engineer MBA, so like nothing else.
Mostly
there.
covered all sectors and stages.
I would say like maybe apart from like
corporate,
maybe consumer brands, I wouldn't have looked at specifically, but apart from that, pretty much looked across sectors and stages.
Got it. No, I think that's a great. Tushar, if you could just give a quick.
Yep. Of course. I'm Tushar. I currently lead all of our India investments for Glade Brook Capital. Glade Brook is a $10 billion global growth fund. India is being 20-25% of capital deployed for us. Some of our investments in India include Zepto, Headout, Pronto, one more which we are going to announce soon in the AI space, right? And the idea is that I lead all of our global fintech work as well as the India investments. Prior to this, I was with the Alpha Wave for about 5 years and started out my investing journey back in the day at Kalaari, doing seed and series.
Yeah, Alpha Wave is primarily multi-stage, right? Like there's no stage focus at all across sectors, across.
It's a global multi-stage firm. We can do seed. Alpha can do private equity. Now they're thinking of doing some things in publics as well. So it's everything in the middle. And it was a interesting journey for me there because during my 5 years, I did everything from seed, Series A to pre-IPO and private equity. Then I did India, Southeast Asia, Middle East, and US, and then I did crypto and non-crypto. So I think apart from private credit, Alpha Wave helped me touch like almost every sort of asset class in the private markets. It was
Great.
interesting.
So for venture as a product, we have all strategies covered that you guys have done in the past.
But we have done it. I don't think I've done it well, but I think we have done it.
Well, okay, that's subjective. Yeah, maybe we'll start off this.
I is very mathematical and objective sort of.
Okay. No, I'll give it to you that. Yeah, so basically one thing that we're really thinking about is how is venture evolving with AI coming in. We talked about, every role is getting, rewritten in some form and shape. Before we go there, Tushar, I know in the last catch up, you were talking about how venture evolves every 10 years, 20 years. You're a very interesting thought process there. Would you please lay it out for the audience on how you're thinking about it? What are your observation on how venture changes every decade?
I think that thought is still evolving and forming. So, I might be inexact in some things. But my sense is that, if you look at the long arc of history and mostly US venture, we have seen it change and shapeshift every decade or every 15 years, which is roughly the fund cycle of each fund of a single vehicle and single fund as well, right? And that is catalyzed by some underlying technology change. So while we believe that the underlying technology change just changes the nature of the investment, I think it changes the nature of investment as a product or investment business as well, right? So for example, during 1990s, you were seeing much smaller firms because the size of the prize was limited, because you were going after relatively capped opportunities linked to capex cycles and physical infra, right? That's when you saw a lot of these telecom companies come out, networking infrastructure, Cisco, like these kind of opportunities, right? So typically the size of the firm at that point was smaller and it was focused, it was niche, it was crafty. Then the dot-com, boom happened. Internet diffusion was very clear and very rapid in terms of its adoption. And you saw the size of the prize increase, but you saw the number of outcomes also increase. And that led to a Cambrian explosion of ideas, of venture firms and of businesses. And at that time, what you started seeing was a belief that venture has to be a diversified strategy where, you size positions roughly equally and you take like the standard, 30 bets in a fund cycle. And you hope that a couple of them will become big enough for you to be able to return your return on your funds multiple times over. Then I think when you enter, I would say starting 2013, 14 to where we are now, I think there has been a market shift in the kind of venture firms which have become successful. And the underlying two things which have changed is, the cost of capital went down during the the ZERP era, and even before that, taper tantrum, all these things were happening. Cost of capital went down, so LP's risk appetite went up, and hence more and more capital started flowing to this private market, which was considered the riskiest product, which is the venture business. And because of that, the size of the firm kept on expanding. So what used to be a great outcome back in 2012 is not a great outcome for a fund which was started in 2015 and was large sized fund. Even though the outcome size and maybe the ability to deliver that outcome has not changed meaningfully, the probability to deliver that output has not changed meaningfully, but that outcome is not good enough anymore because the size of the venture firm itself has expanded because of capital accumulation and concentration. And because of that, what you started seeing was that capital started concentrating even more narrowly, and concentration became the driver of alpha rather than diversification and selection. So it is not just good enough to be in the right companies. Those right companies have to be rightly sized to match your outcome as well. And which is what you have seen, over the last decade with the most successful firms have been, let's say, Thrive, Founders Fund, Sequoia US, like all of these firms, if you would look at their top 5 positions, they would probably make up as much as 30-40% of their cost now.
But was it for over all the cycles, Tushar, like almost top 5 will be like 30-40%, 50% across 1900s, or was it just a recent development?
That would be earlier. It used to be the case that it would reflect in the value that you have created. That 4 or 5 top firms will drive 90% of value for you.
Yeah,
but from a cost perspective, that wasn't the case, right?
Okay.
Like imagine if in those 5 companies, you could deploy more and more capital as well along the way as a venture firm, right? Your outcome will become even more outside. So what used to look like a 5x fund would have probably become a 15x fund if those positions had been sized correctly, right? But the strategy at the time was not that. The strategy in early 2000s was not that. It was that I'm going to distribute my capital accordingly. And the vector is not on sizing the position, but the vector of outperformance is on picking right. Starting 2015, we start to see this shift where the vector moves not just on picking, but also on sizing. And I think that is what has marked the successful firms of last decade to now. That has also been helped by the fact that the power law has really compounded in giving enduring moats to businesses which can become larger and larger now. So I think it's both a function of supply and demand that these things have happened, but it's interesting to notice that this thing has happened over the last decade. And that these things work in decadal cycles, because the answer for the next decade could look very different.
Yeah.
Now it's like, now it's common that now it's consensus views key, I need to concentrate capital behind my winners. Right? Back in 2014-15, if you look at whatever writings, research was coming out, that was probably not the case.
Yeah. And what does it mean, like from what you're seeing in the US and other funds that you interact with? How are they preparing or changing that? I mean, now for the next decade or so, do you see how they're realigning their teams or what kind of investment, processes they have, maybe at the IC level, hierarchy level? Is there any fundamental rethinking about their structural strategy that you see right now?
Yeah, I think it's happening. And we need to observe carefully on what is going on. But there are a couple of, I would say, trends which are going to shape this thing. First is venture in US is now bifurcating into 2 parts. One is that you are a niche, small, sub $500 million fund, where you have a specific network access, or you have a specific viewpoint, or you have a sectoral advantage, and you continue to deploy that at early stages like seed and series A.
What kind of funds will be these, for example?
Let's say Lockheed Groom's fund, Old Wisdom, right? Elad Gill's fund. And there's like, you go to the valley, there's like a bunch of these small, like solo GP type of shops or 2 GP type of shops, right? Which are extremely high on IQ, extremely high on EQ, extremely good on picking managers, and extremely good at having one wedge of differentiation. Could be networks, could be where you come from, could be your views on something, right? And there, the brand building part of it is extremely important. Right. Then you are seeing the other side of like venture firms in the US, which are actually not venture firms anymore. They have become AUM gatherers, which are firms like, which are rapidly raising every year, $5 billion and above in size. Think GC, think Lightspeed, think Sequoia, think Founders Fund, like, all of these platforms, which are going to be multi-strategy, right? Multi-asset class. And for them, the next vector of differentiation or winning comes from not just successfully deploying capital, but also on the fundraising machinery that they build. Because the one big thing that is going to happen sometime this year or next in the US is that the 401k wall is going to break open, right? So right now, 401ks cannot move to private markets. Now there is legislation that 5% of 401k capital can start coming to private markets, right? That is going to open up a floodgate of managers. And where is it going to go? It's going to concentrate towards the most well-known, trusted, performant brands. So there, these managers are going to trade away scale for IRR, but at that scale, moving that amount of money and making like a 15%, 19% IRR is actually not bad. It's pretty meaningful, right? So I think, that's where I'm seeing the US venture as a fund like bifurcate in terms of strategy and what happens going forward. Now throw AI into the mix, and I think that moves the needle quite significantly. Like my hot take is that I think the window to join a VC firm as an early stage or like as an early career person and then becoming a career investor and rising up the ranks has basically vanished or is going to vanish over the next 2 years. And more so at the growth stages, less at the earlier stages, but you're going to see the penetration like happen all over. Because AI is streamlining your processes meaningfully. And what that does to the org structure is that it reduces the need for people to do busy work. And rather, you need to be able to have a small, tightly knit unit which can align expectations, incentives, and thought process quickly and be nimble in their decision-making process. So, I won't be surprised if you soon, over the next like 5 years, see $1 billion fund with just one person or something like that.
I
take
think
it to the extreme.
I was talking to a founder and he mentions he's thinking of his growth raise, but he's not talking to people because most of the analyst associate is not there after 2 years because it's not an on-track role. He's like, what's the point? I'll talk now, and by the time I raise, those people are not there. And I was just thinking, this entire non-track role setup where you come for 2 years after your IT consulting before you go for an MBA, that's pretty much diminishing fast, right? most of the work they do has been support work. Like, I mean, they might do sourcing, but it's not, it's not like they own or they sponsor the deal. So that's what you're also talking about, Tushar, in some form and shape. That's primarily right now more or less in India, right? The non-track role, I don't know how much it exists in US. At least when I look at some firms like Sequoia and others, it's either you come in as a partner, own a deal, become a sponsor, even at a very young age. Whereas is there just an analyst setup that comes support deals where you just
sort of to that question, like not all partners are made equal. Even when you go to a Sequoia US, right? Like everyone is a partner at those firms. A16Z, everyone is a partner, right? Now you don't know whether you're talking to like an associate level partner or a partner, right?
Yeah.
So it again boils down to who the right people at the firm are, the people who can actually throw their weight around, have the cachet and write checks. But ultimately the job of a venture investor in a venture firm is to back their conviction with the companies that they invest into, build track record along the way, and then rise up the ranks to be able to support fundraising and other business side of the opportunity, right? My limited point is that now that, venture firms historically have operated in a pyramid structure, and now the bottom two layers of the pyramid are vanishing fast. And I won't be surprised if all layers vanish and there's just one layer, which is, everyone is a partner and an equally aligned partner or correctly aligned partner, and we all make decisions together.
Yeah. No, makes sense. And Pranjal, you have been across both corporate VC, early stage growth in India. Like, how do you see that game evolve? Like earlier in early stage, there was only few funds, maybe 2015 or before, and they had all the access. Now we see a lot more funds coming. In EI, there is Activate and multiple others that's coming up. Maybe doing this. South Park Commons has come in. Some of the value guys are coming in. So just curious, like when you look at those funds and see how that game is evolving. Broad thoughts on how do you see this thing work?
Yeah, so I think like early 2000s and 90s, right? Like Tushar was mentioning, right? Like just having access to founders or knowing them alone was enough because it wasn't like such a competitive space. There would be maybe 4-5 players who can write a check that makes a founder comfortable that I'm sorted for at least 18 months or 24 months. So you have those 5-6 shops to go to. If you don't get something there, then you end up sort of going to either angels or sort of, some of the other funds and try to put together like a round, right? Now, I think at least in 2010s, definitely, maybe after like the first set of exits where, LPs are sort of looking at venture, not just as like, exploring sort of new age economies, it's more of an asset class. That's what it's become. Because now you're seeing venture funds as big as some of your large public market funds as well, right? So now every individual who's accredited enough would want to sort of have some exposure to private tech companies. They have had some exposure through angel investing, and sort of even if you have one decently performing hit, you feel like this asset class is definitely worth exploring, right? I would say last 5 years, now you've seen like a slew of exits. So that interest level has further increased, right? So now you have, I think most of your venture firms are now inching, like some firms earlier would be at that sort of 100 mil range where even one unicorn sort of helps you deliver like a good outcome on your fund. Now it's like a 300, 400, 500 mil fund, even in India, right? Again, to deliver an outcome there, I mean, venture always has been a decision-making business, right? Like probably in the 90s, decision-making is relatively more important. You don't have to do much of sourcing because there are a limited number of founders building for this ecosystem. Just by the nature of, having the ability to write like a full-size seed check, you have access to the deal. Now you need to have this, sort of team of people that can proactively sort of reach out to founders, make sure that they build the right amount of pipeline. And decision making is at every stage. Decision making is how close do you want to engage with a certain founder? How frequently do you want to reach out to them? What level of relationship do you want to maintain? How can you help them out? Right? So you're deciding how to sort of spend your time, let's say at the lower levels. At the mid levels, you're deciding sort of how to run the pipeline, right? Which companies should get the partner's attention. So in a way, you might call it like filtering, that there's a mid-level guy who's just sort of, let's say, filtering the outcomes. But essentially they're trying to figure out, and it's generally thesis driven as well as team driven, where you're sort of trying to figure out, should this person, attract the attention of the partners, and then the partners are making sort of these final decisions, right? Collectively or alone, depending on sort of your team structure. But essentially they're deciding whether or not to bet on this. When your fund size grows from, let's say, 200 mil to, let's say, a 500 mil, writing the seed check doesn't give you a return on the fund, right?
Yeah.
Because you will get diluted significantly till, let's say, an exit, right? So now that decision making at the mid level and the higher level is not just for the seed check, it's also for the follow on check, right? Which I think the position sizing that we talk about more in India is, today, if you look at any like early stage fund, generally they're going to reserve 60 to 70% of their corpus or for the follow-ons, because essentially that's where you're supposed to make more and more value, right? So now that decision making or evaluation structure has to be repeated again and again for the same set of companies. You have to take that growth lens as well, because let's say in a seed stage environment, you're sort of more looking at thesis and the team quality. In a growth stage environment, you're sort of looking at what kind of exit environment are you looking at, what kind of growth trajectory will the company take, what kind of capital will it require, right? So it's a much more nuanced decision, and the teams have to expand to enable that decision making, because now you need a team that's not just doing outreach and like running the pipeline, which is sort of speaking to founders, doing visits, etc. You also need people who are sort of running these constant data sheets, comparing different growth outcomes, right? You would have backed some company at the seed stage. There is a growth round coming up. Whether or not you do like a super prorata and bid upfront depends a lot on how they are sort of, competing with other guys, right? So it's a different sort of mindset you need to bring in.
Both to you, Pranjal and Tushar, we talk a lot about moats for our companies. When you think about moats for yourself as an investor and the firm, when you're going forward, what are the levers you see? For example, I'm sure nobody disagrees that network access is a compounding mode for humans. Might or might not replicate that very soon. But when you come to the entire judgment bit, right? I see people developing domain expertise, like just going deep in consumer, and there are shops that enable you to do that. You own one sector within that shop and just go do that. And then there is like stage expertise. You do everything, but you do a seat, and your entire thing becomes network or whatever. How are you thinking about that for both yourself and firm in terms of what is the moat that you're developing?
Yeah, I mean, I can take that a bit, I guess, because I've seen like some of these cycles play out. But essentially, I think from an individual perspective, your moat is your expertise, right? Because you're dealing with internal stakeholders, which is people within your firm, and then you're dealing with external stakeholders, which is like founders, some of the management teams you engage with, and this occurs both in sort of diligencing an opportunity before investing, or even post investing, sort of engaging with the founder or engaging with the management team to try to deliver or drive a certain outcome or decision, right? So I think there. Market expertise, sector expertise, understanding sort of data, reading as much as you can about the industry and other players in the industry, having that knowledge base, and sort of putting forth your points and discussion areas in the right way is that moat. I think from a firm's perspective in this age of AI, while that knowledge base could be considered a moat if it's there at a consolidated level, I don't think it's there that much, because now what happens is, as a firm, you kind of think of like an organization structure, right? So is your organization, I would say, nimble enough and fast enough to get to a decision? Because at the end of the day, all of investment managers, you might think of it whichever way, you're managing assets. Essentially, the alpha that you create, which is the IRR above market, is coming from decisions. The decision could be to sell a particular asset at this point in time. The decision could be to sort of buy into an asset. The decision could be sizing your follow-on check. The decision could be sort of just assigning a valuation or sort of trying to negotiate a certain valuation. That decision, how fast you get to it, how much you sort of spend time on due diligence more and get to the exact answer versus hastening your decision, so that there are sort of benefits you get by getting there faster as well.
So, Pranjal, just one question on that bit is that when you said you can build expertise in the judgment bit, there are choices to make. Like, do you go deep on one sector and say, I'm going to be an expert in the sector? Or on a stage and say, I'm every Series B deals or every early stage deals, I'm going to be expert in that stage. When you think of trading time to build some expertise in, is there anything you see, or is there a broad thesis saying, hey, I'm going to be, network effects is my thesis, and anything and everything in network effect across stages and sectors I'm going to look at? Like, I'm just trying to think through that bit on how do you think about that?
So I think it's kind of like building like a T. Yeah. Right. So you should understand a bit of the macros and nuances of each industry, which means, being in touch with the macros, right? If something is happening in a certain industry all around the world, which means like today, if I cover logistics, I can't put my hands up and say, I don't understand what's happening because of generative AI, right? Like you have to sort of understand how the models work, what people are using them for in other industries, like what are the sort of best advancements and biggest threats that are coming in, and how does that apply to your industry, right? So you need to understand everything horizontally. Understanding some things deeply also give you expertise to say, one is obviously you have expertise in that particular sector, but given you're dealing with a lot of new age businesses, you will come across business models where there are nuances that might align with something that happens in a particular industry, right? So while let's say, you might sort of Look at a B2B marketplace. Now they deal with, let's say, ROCE calculations, working capital calculations, pricing in a certain manner. While somebody might say logistics is about network effects and sort of, building like a mesh network and other things you've seen, there is a core value because it is essentially a B2B sort of sale that's happening, right? So there are still those nuances that you need to bring in. So having that level of depth and understanding how, let's say, your portfolio or the companies you're evaluating actually function on a day-to-day or at least on a week-to-week basis, right? That sort of gives you that expertise to also evaluate companies in other sectors, right? So that's the expertise bit. Other than that, I would say as an org, expertise, generally what happens is expertise helps you get to a decision faster, right? The other thing is, I would say like the other thing is how your org or your investment process is designed to get to, let's say, a decision faster without having to give up a lot on the diligence aspect, right? Because let's say, within 2 weeks or 3 weeks of diligence, I can get to, let's say, 80% of where I need to be, or 80% of, the know-how of the business to be able to take a decision. Now you can choose whether to take a decision there. Maybe there's an advantage that you get a better price and, there are fewer competitors that will come in with an offer at that same point of time, right? Or you spend another 2 weeks to go from 80 to, let's say, 95% conviction, right? Now by then there might be two other offers on the table.
Yeah.
Yeah. So I think just balancing that trade-off, and that's why I feel that mid-layer would still probably be important, because decision making from that perspective is not just it's a go or no go. It's a sort of also where you spend your time, what you prioritize, right? Because even for like a small 3-4 person shop, you will probably come across at least 100 plus opportunities even within a particular sector, right? So you do have to sort of make that decision of prioritizing where to spend your time.
And Tushar, is that thought process broadly similar?
Yeah, look, I think, I think we're aligned on most things. I would say that what I'm seeing happen is that the process part of the story is getting commoditized and getting automated and streamlined very quickly. I mean, last time, I don't know last time when I actually had to like physically start wiring a model, right? Like I stopped doing that. We have a set of templates. We know what templates we want to pull, right? And all of our time goes on just figuring out which assumptions move the needle the most and just diligencing those core set of assumptions, right? So I would say that it has led to a higher level of abstraction from the process itself. Another example I'll give you is that we were diligencing a consumer internet business recently, and earlier I would have done maybe like 50 consumer calls, right? As a team, we would have spoken to like 50, 70 consumers at best, like a 2-member, 3-member team over a week. One of my colleagues spun up a voice agent, which went ahead and spoke to like some 1,500 users in like 3 days, right? And that was the best amount of insight and diligence knowledge we could like actually agglomerate as a team, right? And make a go or no go decision. So I think there is a degree of abstraction away which is happening from the streamlining of the process. I'm seeing that happen obviously at a much faster pace in the US than I'm seeing here in India, but it's happening, right? The diffusion is going to be global in nature. So that in my mind has moved the vector as an individual first to 3 things. First is your lateral thinking. I think the ability to be able to, pull contexts from different aspects of the world, stitch them together, and then, create new frameworks and ways to think for yourself, or that new learning approach. I think that has become extremely critical. It has always been important, but now given that access to information is cheap, far and wide, the bar has shifted higher on you to be able to do that. Right now, learnings can come from what DARPA used to look like in the 1980s, or, something as tactical as that, how is Databricks designing its sales team and creates incentive plans for it, right? Because access to knowledge has become so cheap and access to intelligence has become so cheap. The vector has shifted to synthesis to your specific context and being able to be creative in your thought process, right? So I would say that's one thing that I sort of think is going to still differentiate you from others going forward. Second here is, people loosely call it taste, but I would break down taste because I feel taste is a cop-out now that is being used quite a bit, right? I would say taste has 2 components to it. One is judgment, second is experience, right? And third is your read on the founders, right? And all of these 3 things are very like soft in nature. And it's hard to like exactly pinpoint on what drives what. But I do definitely think that there is, as I'm getting older as well, I'm realizing that things that I used to think were true earlier are not true anymore. And, as a young associate, I would have said, oh, the partner doesn't get it, right? Now I'm starting to see what has impacted those cycles of thought process and change from what their lived experiences have been, right? And there is no way to speedrun experience, essentially, right? Like experience is the term exists because it's a time series term. It's not a stock term. So I think that's one. But I would say like first was lateral thinking and creative thought process. Second would be like this loosely defined as taste, and third I would say is here, as Pranjal rightly pointed out, it's sales. You are selling to different stakeholders. You are selling internally. You are selling externally to founders and to LPs. Like Navroz, who's my ex-boss from Alpha Wave, gave me a very interesting framework. He said, you meet 100 companies to decide the one that you're going to invest in. You better be damn sure that you're not losing out on that company. You don't lose out deals basically. If you lose out a deal, that's criminal because you have to now speed run another 100 companies to get to the right outcome. And the worst case outcome is that because you want to do a deal, then you'll keep lowering the bar if you're not able to win the best deals, right? And that is criminal in our business. So I think these three skill sets are in my sense important for an individual. I would say as a firm, there are three things again which I think are important. First is the army of Avengers that you build, which is the team that you have, and what is the diversity in the thought process of the team while still ensuring that there are certain common values which holds the team together. I think that realizing is a very like cultural nuance which people miss out on, because in India we have seen firms which have historically been two top people and an army of people around them. Whereas in the US, it works slightly differently, where there is a partnership of equals, or if not equals, there is like a much higher bar on who enters the partnership eventually. And that I think is just a generational shift which happens over time. You will start to see that transition happen in India soon enough as well. So I think diversity of thought process while having commonality in values, that's sort of one. Second is how do you align incentives for everyone across the org? I think that's a very underrated lever in VC or in investing business, which gets overlooked quite often. But I do think that the choices you make on aligning incentives is the output you get. For example, if you are a firm which is very heavy on analysts and associates, you're going to have very high coverage, but also very high degree of internal competition than external competition, because the pyramid is going to close up soon on those people, right? And then the incentive is, oh, I need to get my deal done over someone else's deal, for example, right? Whereas, let's say if you are a benchmark style partnership where everyone's carry is weighted equally, everyone has an equal say, and still you can go ahead with a veto on your investment ideas, right? There, the incentive structure is completely different, where you are all helping out each other in making the best possible decision and making the company successful over time. Yeah.
Just one on that, right? Like when you do, I seen equal partnership work really well. Partnerships stay really long. Maybe in India, Axel is an example. But there's also that caveat of 10 partners, but one guy really get the carry pool really comes from one or two deals that this guy has done. You've seen play out in one venture fund where people have left and started their own fund, where they just don't feel equal is the right way to do it, right? So do you see anybody doing that well? Because equal partnership has that merit, commerce. When you do differentiated, people leave. It looks like
it has to be it's something which has to be practiced every day. Equal partnership is something which is practiced every day. It's not something that you just sign on a piece of paper of carry and then you try to retrospectively allocate it. So that's why I'm saying, I think it's a cultural decision first on what type of a firm do you want to build, and then you align incentives accordingly, which is the carrot and the stick, right? Like for people to come, stay, and perform. If you think that in an equal partnership that people are coasting, then that coasting will only last one fund cycle, right? Like then you will churn them out and there'll be someone else who will come in, which is again the benchmark model, right? Benchmark from 10 years ago when I joined venture and now is a completely different set of people. But the institution stays and carries on with the same set of cultural values. So yeah, I think it's a cultural answer. It depends on what type of firm do you want to build. There are single person firms which have been pulled up by just a single person and are doing exceptionally well. There are equal partnership type of models which are also doing well. It is about the ambition of a person, what they want to do, what they value. Not everyone wants to be the top dog in the house. Someone just wants to be like a great individual contributor while working in a team which supports them to be successful, right? And that model works really well. Right. So I would say that was the second part on the venture firm. And third year, I think increasingly for the next decade, fundraising is the mode for all of it. And fundraising can have elements of machinery building and also the brand to it. But
what is machinery building and fundraising like?
Yeah, like just having you guys have a big IR team, right? And most shops will have IR has moved from being a back office or a support function to now actually being front and center, and it will just continue to happen. So far, what has happened is that IR has been run like key partners. The IR is a BD job, and the partners will go wow the LPs and get the money in. Now I think it's changing, where the IR is a 24/7 annual function where you are bringing in capital, developing capital, pools of capital, right? Different bases, global, all of these things. And not just for smaller and emerging fund managers, but across the board for everyone.
Sorry, just doubling down on that link. All the funds I know, IR still is mostly a BD function where the partner goes and wows the partnership and gets it, right? Where Where have you seen that change different in the sense that what are the machinery you can do where an IR analyst can actually create a capital pool which didn't exist before? Because usually even now when somebody is looking for a partner at a new fund, it's also apart from deal access, there's also that LP access pool on what you get in right now. At least in India, that's still a large area of how you decide, right? Do you see that changing? At least I'm not able to comprehend on which funds would that, how would that look like?
Yeah, I would say like you should look at any of these big US platforms, right? Like GC, Lightspeed, वगैरह. One or two GPs in those firms, they don't invest. They only raise. Right? They only raise. And raising capital has become almost like having a person sell a highly technical software solution. You know how for technical sales, you have engineers who go and sell, right? And because they are able to speak the same language, they are able to understand the problem statements really well, and they are able to design a solution accordingly, right? It's the same thing which is happening in venture, where people who have either been ex-investors or know how have worked around the same ecosystem know what to sell, how to sell, and when to sell. And it's a very specialized function. And they can have like teams under them, whatever the structure might look like. But it has moved from being, like I said earlier, support function to like a front and center priority and function for them. I'll give an example, right? Like a couple of these US platforms now run quarterly calls where the links are available for anyone to join. And why are they doing it? They're almost running it like a retail shop now, right? And why are they running it like that? Because they know that if I'm able to build trust in the HNI community, in the private wealth channels, then when the 401k wall opens up, people are going to say, oh, I have to go to fund A and fund B, and that's where I want my money. It's the same thing why a Vanguard ETF exists, right? Like when anyone could have had ETFs, but Vanguard has the most liquidity around it, right? So I think that's where I feel and then there are US interesting structures, yeah, by the way, happen in US. Last 1 year, if I'm not wrong, 85-90% of capital raised in private equity was raised in evergreen funds. And evergreen funds are basically, think of them as hedge funds, but for private markets, where LPs can redeem capital every quarter to certain like thresholds and limits and what that bells and whistles might be. But that is a great product for LPs because now you have taken away the liquidity risk. But now then that designs the kind of companies that fund can go ahead and invest in. That company then cannot be logged into fully an illiquid portfolio. It has to be somewhat liquid portfolio, which the US allows you to build because companies like Stripe, Databricks, like all of these cash printing machines, they do like regular buybacks and things like that. Right? So for that type of a fund, the IR function is very front and center because अगर अभी 10% रिडीम हो गया तो मुझे अगले क्वार्टर में 10% लाना भी तो है ना. So I would say like these three things on the individual and then the next three set on the firm.
Yeah, no, that makes sense. Like what fundamental question pe aate hai, which let's say I put a gun to your head and say you have to start a fund and it's not Glade Brook or Creagis or any of the funds that you work with or seen, right? And you can do n number of capital available, pick a strategy, whatever you want to do. I don't have an answer, but I'll give my broad thought process on interesting strategies I've been thinking about. I would love some thoughts on you guys, right? Like, there's three broad strategies that's been really interesting. One is the Green Oaks kind of a fund where you only do 5. You're highly concentrated. You've been tracking them for a long while, and it's probably largely consumer, I would say, a lot more sector focused. Within that, no geography barrier, the sector focused, stage focused. The expertise they're building seems to be a lot more about one sector or at one stage, ability to underwrite that across geos. Other strategies may be a core 2 where there is no sector stage per se. They're happy to do a seed. They can come to growth. They can do public. They can move along the line whenever there's higher valuations in growth. They can come to seed or public. So the market cycles between stages or sectors doesn't affect them, but there's a very different ball game altogether, right? You are attuning your firm and your investors to play that ball game versus a Green Oaks. And the third is what you, Tushar, earlier talked about, more private equity style. I mean, let's take GC, for example. I'm seeing a lot more of that activity in India where you're owning 70-80% of a company, like platform creation, so to say. GC is doing that. I can see much more growth funds in India, which is now trying to do, 70-80% ownership in an IT service company where you incubate or build a platform from day one. I used to be W Health where you used to do some of those things. It's an interesting strategy. Fully, it scales. People are trying to do 100 million seed in a platform on day one. I don't know how it will play out, but seems an interesting strategy, right? So those 3 sounds interesting to me. I'm curious to know what you find interesting, what you find not interesting.
Yeah, I mean, sure, I can take it first. I mean, all of them sound interesting. I think, all of these can be successful in India or globally, wherever you sort of want to launch them, right? It's just, I think like Tushar had touched upon this quite well. Can you build your firm around the right way, right? Like one is pick the right team. Right. So, for example, the first structure you're talking about, like a Green Oak structure, where you have sector expertise and will take like 5 bets. Right. Now, if you're going to run a highly concentrated portfolio, if you think about alpha creation that needs to happen, right? typically if you're doing like 30, 40 checks, you would imagine that all my alpha creation is in the decision making of which are those 30 checks. Because I anyway have to spend a lot of time on that, do a lot of coverage, outreach, a lot of pipeline that I have to manage. If I'm focusing on a particular sector and will only do 5 checks, I will have a very selective bar, right? Like maybe I am very strict on unit economics, for example, right? If I'm running, let's say, a consumer brand business. So anyway, I will not be taking that venture risk of going after, or even spending time with the business, which has this new product that's about to launch, which is very exciting, but it's not commercialized yet, right? So for example, then your pipeline activity generally becomes lower because you have some of those key metrics you want to look for. A lot of time has to be then spent on portfolio to generate that alpha, right? So then on the portfolio side, can you help sort of the founders with strategic thinking? Can you help them source M&A activities? Can you help them sort of source new business lines and customers, and sort of help them with even like sector experts at your own expense, or however you want to structure it? But like, can you work with the portfolio to help generate alpha in what you've already committed? Because most likely you will do like 1, maximum 2 deals a year as a fund. So then you want to spend a lot of your time trying to generate alpha. So then you need to have the right team structure for that. Do I have people in my team that can help on the operational side of things, right? If I'm working with consumer brands, can I have somebody who's just dedicated on marketing, right? Somebody who can help me with, let's say, performance marketing as well as brand marketing. Is there somebody who can help me with offline expansion, help in sort of how to run that pipeline, identify the right real estate opportunities? Is there somebody who can help me with promos and pricing, right? So you will sort of look for that expertise. Second, yeah.
Given where we are in India and right now, and you had to start a fund, is there a strategy that you stick on to based on what is doing right now and what can last maybe 20, 30 years from now? Is that something interesting for you from the funds you've seen and where India is today?
Yeah, I mean, I would say from, let's say, the current view, like I would not want to, let's say, align myself to a particular sector, just given sort of there is a lot of sort of migration happening in general, right? Like consumer spends are moving from one bucket to another. Consumer attention time spent or etc. is also moving from one bucket to another. I think what would sort of ideally make sense is to run like a growth stage strategy, focus on these sort of 20 to 50 mil checks, right? And run like a diversified portfolio. Because I think today, and I think the third option that you mentioned on platform creation also sounds quite exciting from that point of view, because we are at an interesting inflection point where everything is going to change drastically. It's already started changing drastically over the past, let's say, I would say couple of years, and more significantly so over the last, I would say 8, 9 months alone. Over the next 2 years also, there is expected to be like a drastic change, right? So I think you were seeing in the public markets, Indian IT stocks are sort of, many of them are at all-time lows, but there are sort of these flywheels that have started to kick in. So there is this inflection point where you have opportunities to make sure that you can get the best out of, or you can participate in the best activities happening in each and every sector. Right now, it's just that you have to think of those opportunities from a generalist lens and figure out, hey, let me break down, this sales process in this certain industry. Let me break down this operations in this industry. What all can AI do today that can help me sort of deliver like a better outcome? And then your objective overall would be to evaluate the teams to figure out, hey, have they sort of in the past been able to identify similar opportunities and make their business better? And in their current sort of scope of thinking and future thinking, are they planning to do things which you believe will sort of help them, let's say, create like a better outcome, right? Either it be I implement some tools to deliver like better, let's say, sales efficiency. And I've done that in the past, right? I've always adopted new technologies and new ways of thinking or working to figure out how can I improve this? Can I do something to help figure out, like, from a consumer brand lens, right? Can I do something to figure out
From
how
support
to do
team,
the right way of pricing? Yeah.
focus on one sector seems to be one vector for sure. And then the way you said, you're not committing to a sector because things keep shifting, valuations keep shifting, deal flow keep shifting. But is there really alpha in being stage focused, or you said growth? I mean, there's depth of capital and growth, but would you still allow yourself flexibility to say let's do seed as well as growth, depending on how deal flow valuations are shifting, what's available versus not?
Yeah, I would say like growth stage still seems like an exciting space. Series A, B, and C, I would say, because I think I would say, at least from like a venture landscape, right? Seed stage is generally quite well sorted. I would say there is a heavy amount of competition. There are a lot of folks. It's
exhausting. And if you had to see, if you have to do seed, probably you only have to do seed. Like your energy entirely goes into that. I don't know. I'm just putting out thoughts.
Yeah. I would say at a growth stage, though, you do see that when a founder starts out at seed, right, he or she imagines this journey that they're going to go through sort of certain milestones, and they'll achieve those certain milestones, and then that's how their org will sort of set up. But generally, what happens is by the time they reach like a Series B, right, they would have been chasing a certain milestone. And because of that, they had to change their org structure, change their incentive structure in such a way so that that milestone got achieved. Because, they were told either by investors like us who were evaluating them that this is the milestone you need to achieve, right? You forget all else. So it's not the balanced sort of grow in organization that they sort of took up, right? It's not, let's say, the ideal sort of situation. At growth stage, there's this unique opportunity where you kind of come across businesses where there are overall 5 levers. 2 of them are working well. They need to set up a certain org structure to sort of make sure they are working well. 2 of them are, let's say, slightly firing or just about to fire, right? So there is a certain org structure that they need to make those work, which is probably similar to their seed stage org structure. Then there is like this 5th or 6th engine that, they're just conceptualizing, right? That requires a completely sort of, let's say, different team that you need to build out, right? And in the future, this will always be there, right? Maybe these two engines join this. So then they need to shift or migrate this org here. But you need to kind of set up this sort of right sort of concept, right, at this stage. If you go too late, even your, let's say, steady business lines that just need to sort of grow and sort of, set up new offices, new geographies, those will not sort of be, let's say, templatized in the right way. And then everything else sort of starts to go this way. Either there'll be some inefficiency on account of, let's say, decision making, on account of team sizes, and that will reflect eventually in the P&L. Maybe not today, but maybe in like a year's time when something happens, right? Something adverse happens. But I think like you're at this unique sort of situation where, you've got this time to sort of reset, set up the org the right way. And that expertise, I feel, still comes in, right? Because while we keep talking about, in growth stage, you'll evaluate numbers. The next round guy is going to look at these numbers when they're evaluating you, and we need to make sure these numbers look good. At the end of the day, all of these decisions come down to who's the right person or who's the right team that I need to bring in to sort of deliver these kind of numbers. How do I incentivize them to make sure that they sort of work towards these right numbers, right? And sort of how do I enable that faster decision making, seamless decision making, information flow as well? Because most of the time, I think, and this applies to both funds and I would say companies, a lot of times decision making is weaker. Not just because, you don't have the data or you couldn't collect the data. It becomes weaker because, let's say, there is information flow that's kind of being blocked between people, or the decision making process, right? It's a little flawed, or it doesn't align with your thesis or the way you want to sort of approach the market, right? Early stage funds, people who want to write 30 checks a year, they have a different volume of pipeline coming in. They
And
need
they
a
have
different incentive
centralized
structure,
processes.
different decision making process. And somebody who's just going to do 5 checks needs a completely different decision making process. Yeah.
And how do you think about Tushar? If you really had to put a strategy together, what kind of funds excite you?
Yeah. So look, I think we'll start with the fundamental premise first, right? Which is, let's say, India is right now, at the start of last year, $4 trillion of market cap. Now it's probably 3, something like, 3.5, something like that. All of tech or new age tech companies, VC-backed tech companies is probably like $150 billion of market cap. So it's like still early innings. We're like 5% penetrated. US mein pura max 7 is like, 80% of S&P, right? So I feel there is no way that the future of market cap creation in India is not touched by venture as an asset class somehow, because it is all going to be technology driven and it is all going to be innovation led. So it has to happen, right? This 5% will go to 30%. This 3 trillion will go to like 10 trillion over time, right? Or maybe not 10 trillion, will go to 7 trillion over time, right? So you're talking about, like if you do the math, it's like you're talking about multiple trillions of dollars of wealth, which is to be created still by the Indian tech ecosystem over the next 20 years. That is inevitable. We might have some years of success, some years where GDP is not going well, whatever market caps is not going well, and that leads to pessimism and mood swings. But fundamental currency is that जो भी market cap creation net new होगा यहाँ से, वो जो है tech companies के through ही होगा, or majority of that is going to happen via tech companies. The problem though is that public markets still don't understand how to underwrite tech businesses really well. And that's the unfortunate reality, because the public markets today, domestic institutional investors today, there is a new crop of investors which is coming up, which is like tech native, right? But these are people who यार जिंदगी भर Unilever और ITC में पैसा डाला, right? Or tech for them meant being part of the TMT team, which meant कि Jio और Airtel में पैसा डालता है, right? Like the same guys who now are underwriting Meesho and Urban Company are the same guys who were like underwriting, Jio's tower business 5 years ago. right?
And that's a very Indian problem, right, Tushar? In US, you see SpaceX be under
US में यार वो हो चुका already. US में we have gone through that generational shift.
Yeah.
Right. US में वो problem probably 2005 में था. So that generational shift has already happened in the US because again the fundamental market cap creation has been done by the Mag 7, right? Or like these tech companies. So if you're a public fund today and you don't understand tech, like your fund will basically not exist. Right. So pulling it back, right? Basically the idea is that public markets still underappreciate tech and what value tech is going to create. Private markets understand what tech can do, but can only go up to a certain level. So what I think think about doing, and I don't know if I'll get the right to do that or not, but what I would like to do in an ideal world is do like a growth firm where you can straddle across privates and publics. And you have a well-defined strategy of what percentage of a portfolio is going to be publics and why, right? Things like that. But you start with maybe 12 to 15 names in every fund cycle. You divide those names one third into three buckets. One is like the net new public exposure you are taking. One is the mid-market growth equity portfolio that you are building, like let's say companies between $200 to $500 million of valuation. And third is the $50 to $100 million sort of entry size checks. You will divide the names one third, but the position sizing will be very different. So for the bottom third bucket, the position sizing will probably be like 20% of cost for you. Right? For the middle bucket, it's probably going to be like, that's where I'm going to deploy like bulk of my capital, like 50-60% of my capital, right? And the other 40% or 30% is going to be in the publics, right? The hope is going to be that during each fund holding period, companies will move from bucket number 2 to bucket number 1, which is like move from mid growth to publics, right? Public companies will go from, let's say, a $5 billion enterprise to like $25-30 billion enterprise over my holding period. And the bucket number 3 will graduate to bucket number 2. And then, you run the playbook again from the next fund, where you are investing behind the same companies that are known knowns and the companies that you like over and over again. And you keep concentrating capital, not just in a single fund, but across fund cycles.
In which case, your entire strategy is dependent on getting the first bucket right? You're graduating companies across the same.
It's actually not. It's on getting the mid bucket right. The first bucket is just option value. Ho gaya, because that's only 20%, right? Like that is not going to be a make or break for my fund. Yeah. If the second bucket is right, and in second bucket, if I'm able to perform well, then the second bucket will move to the first bucket, right? And in the next fund cycle, if those companies still have the fire behind them, then that first bucket will continue to sort of compound again from there. Because the belief is that tech is going to generally lead to overall outperformance versus the other sectors in the economy, right? And that diffusion then has to show up in your portfolio as well as the earning potential of the company. The second thing I think the public book allows you to do though is play tactical bets right. For example, I've been, spending some time thinking about manufacturing and defense, all of these things. And one of the things that I keep coming back to is the companies, at least the current crop of companies that we are seeing, they are interesting and good, but they are not fundamentally moated or differentiated. And hence, these companies are winning orders right now because there is a point in time opportunity where defense procurement has gone up, for example, right? But what you're also seeing is that as soon as that opportunity becomes real and visible, more and more competition starts in because moats come.
Can you give an example on this? What do you mean?
Every day I'm pitched a drone company, right? Okay. Like I don't even know how many drone companies I've been pitched this year, right? Like, and it's like, all for good reason. These companies should exist. But is my capital the right solution for them right now? Not, right? But you are seeing like if I had a public markets book, right? And I didn't believe in the longevity of a theme from a 10-year standpoint. But I believed that ये 3-4 साल का तो theme है, right? So I can take that exposure from public markets and keep cycling in and out, right? And that gives you like a sweet spot. And that like those tactical themes you can play well from a public book. Within the tech sort of scaffolding, while not getting locked in, where during your holding period of the fund, the company can go through cycles of, formulation, growth, and then commoditization, all in that 10-year window, right? So you don't want to be stuck on the wrong end of that bargain, because by the time companies come to us, they would already be on that up curve where the monetization has started happening, right? Companies have started proving PMF and things like that. And then you don't know what is the cusp to commoditization. Is it 2 years? Is it 5 years? Right? And you can be stuck with companies at that point. But the public markets like just give you a lot of flexibility to be able to play with that. So I think it's sorry, go ahead.
I was just saying, what is the key thing to get that middle bucket? The entire strategy depends on getting the middle bucket right, like $200 to $500 million, right? What is the key thing to get that right? Are you saying based on your experiences and since you've been in the space for a while and that suits your skill set, that's something you will do? Versus, there a playbook you're thinking in mind saying, this is the key thing that's helped me get it right?
Yeah, I think as human beings, we get seduced by building frameworks and playbooks. I think it's like, value gets created of narrative violations only, right? Like it's not, but I would say like, look, I think people start, I think this is just general misconception on founding teams not mattering as much at growth stages. And I would tell you, some of the smartest investors and some of the most successful investors around us, if you talk to them that what is the single most important thing you need to get right in growth, they will say it's the team, right? It's the founders who still are, bending the arc of the business, are still pulling you out of gravity, right? Like you have to analyze things, and hopefully the quality of the founder will show in the numbers as well. But if there are 5 things that you want to underwrite and you think are important, maybe 2 or 3, like Pranjal said, will be working right now. The other 2, you still have to take a leap of faith. Right. And that leap of faith is what? Like, it's still the founding team. Right. So I think it's the size of the prize that we are doing a lot of hard work in company building. Is that going to be worth the effort in terms of the size of the prize that we are going to build in the future? And second is the quality of the team. I think that is where I spend like basically all of my time.
And Pranjal, Tushar, one question to you. I mean, that sounds very interesting, but beyond that, both of you have did early and growth. Don't you think all those early funds sitting on a shit ton of capital, they do, spray and pray, or say large range of portfolio, some starts working and they have 60-70% reserve kept to back those guys. They're holding it so tight, not letting other growth investors come in at all. I mean, at least the top decile at all, where you can really see it firing. Do you see that happen where they're holding it so tight, not letting other guys come in, at least at the Series BC level?
That thankfully, more capital is always welcome, is what I have felt.
At a much higher valuation, right? Like somebody raising at a 20 mil, say $1 billion valuation, they're okay to take it, versus would you get it at a right price at all?
Well, I think at least at this point in time, it doesn't seem that to be a big problem. Okay. I think this might have been a problem back in 21.
Okay.
But doesn't seem like the experience of the last 2-3 years. In fact, I would say most people are complaining that there are no like Series B and above funds right now. Like, there are very few shops. And I think it's a very opportune time to be doing it. I don't know, Pranjal, if that's been your experience, but at least that's what I felt over the last couple of years.
I agree with you. I would say like last couple of years, actually, you generally have had the better pick of the assets, right? Because there are fewer shops who are willing to underwrite a 30-40 mil check. I think, we've also been at an advantage because we were in our first fund, starting in 23. So we a lot of other folks would have like these sort of old portfolio things that they sort of had to work with from our 2021, 2020 vintage, right? So one is, I would say, like just from a longevity point of view, right? Be it venture or like early stage, be it growth stage, be it like late stage public markets. I think the biggest sort of element that sort of keeps you standing out and that's stayed across the board is discipline, right? And I think the opportunity that you get to slip up, right, or an opportunity that can come in for like somebody else to sort of make a mark is when somebody else misses out on discipline. And I think like Tushar is talking about, some of these larger funds, with 20 years, 30 years of vintage, right? The reason they're able to sort of outsource this fundraising process to an IR team is because they have these 15, 20 years of vintage to talk about how we have always remained disciplined on processes, right? What happens is if you do even 1 or 2 slip ups, right? Especially at like if you're running a concentrated fund and you miss out on you let go of some of your, let's say, hardline, base case parameters and say, okay, let's underwrite this company with a lower margin, even though, my thesis was always that I will not invest in a business with like lower than gross margin of this, or with working capital extending to this, or anything that does, let's say, for example, government business or anything.
Yeah.
If as soon as you start letting go of some of these and one of those sort of goes wrong, that's when you sort of let this opportunity come in, where one is you then have to manage stuff on your sort of investor side as well, because you let go of discipline. So I think that's probably the key from a 15-20 year cycle point of view. From sort of this multi-stage fund that Tushar talked about, I think I would agree to do like something similar, but that would also help me on the fundraising side, right, to maintain continuity. Because let's say if you're running a portfolio with, let's say, 15 assets, right? If all 15 of them are Series B and C, it's like single stage. Now, next fund, when you're going out to raise, what do you have to show? Right? Like you can show ki all of them have, like maybe 5 or 6 of them have done like next rounds, 2 or 3 of them are not doing so well, revenue's flat or something. 2 or 3 of them have grown well, but there's no follow-on round that's happened, right? So I don't have technically anything to show for it. Now, if you think from a conservative investor side of view, right, they might not count that for anything, but you definitely don't have any exits to show for fund 2. Right. I think if you're all doing like Series B, Series C checks, probably by fund 3 as well, 6 years down the line, you don't have meaningful exits to show. Right. So if you go to an LP and say, you gave me $100, just hypothetical numbers, you gave me $100 in fund 1. In fund 2, I showed you fund 1 companies are doing well. Right. So you feel happy. Now I asked for another 150 and, it's a good fund. I've done well. fund 3, I'm asking you for $200 again. Like the third time, I can't come in and sort of, ask you for money without having returned anything to you, right? So ideally, in a very well structured fund management business, if you want to sort of have that continuous flow of capital coming in, you need to deliver like net positive cash flow for the investor, right? That my next capital call is being serviced by the returns I'm giving to you from, let's say, 2 or 3 fund, like vintage older funds, right? If I keep asking you for money and you're keeping on drawing down, I mean, obviously a lot of these, pension funds and all have patient capital, but like you can't sort of take in money and then 15 years that you're still sort of asking for drawdowns. So uh, I think if you're able to deliver that and structure your portfolio in such a way that you at least have 3 or 4, let's say, Series D and above companies, which will liquidate, might not be an amazing outcome, but at least in 4 years' time, after Fund 2 has started, right, some of the capital calls from Fund 2 at least are being serviced by those cash flows. And then by Fund 3, you can kind of say that, hey, I have the late stage companies that have exited. And then some of the mid stage companies that did in Fund 1 are also starting to deliver exits. So now when I go back to you and ask for Fund 3, I don't need, let's say, the managing partner to go and meet people because I'm not asking you for money. I'm asking you to reinvest the money I'm returning to you. And that's when, somebody, I mean, it doesn't have to be US focused. It can just be India focused, right? If I'm asking you to give me money that I'm giving to you,
Makes sense.
You're happy to pay that in.
Makes
Yeah.
sense. Like, I know a little over time. Do you have 10 minutes for one more question? Do you have hard stop?
I can go.
Yeah, sure.
Yeah. One last question I want to cover is, what is the strategy that you'd absolutely not do? Let me give you one example that I can think of, right? Like picking one fund in a 10-year fund cycle and sticking on to it seems something that I would personally not do. I mean, this might differ, and I've seen funds do well in some of that, but usually for certain sectors, way cycles work within that sectors, made valuation, made deal flow, it could really throw you off the track. I'm just throwing out example here, but is there a fund strategy, broad strategy, or a sector or a model that you would not?
Yeah, the answer has to be like extremely personal. Actually, it is like what your style and preference is.
I'm not saying it don't work. If it does not work for anyone, I'm saying something that you are not comfortable doing.
I mean, I've done it in the past, and I will never do a crypto fund again.
Okay.
Yeah. I would say like some of these thematic funds you probably won't want to, right? Like be it crypto, be it gaming, be it FinServ, or some of these sectors which are either regulated,
yeah,
or they're not like well established large sectors, right? Where there are 3 or 4 at least easily large outcomes that can be created. Because if you're looking to deploy 15 checks in a certain sector, and unfortunately this is probably a bigger issue in India. Like if I were in the US, I could easily justify like a 500 mil sort of sectoral focused fund. I think in India, that bar or that cap probably hits at 200, 300, right? And I won't name funds, but like
fund size beyond a certain point is what you're saying. Makes sense.
Actually, I think 200, 300 is very generous, Pranjal. I would say like 50.
Yeah, I mean, I don't want to be like that. That sort of negative, but I'm just saying, like, I mean, there are sort of plenty of
maybe
funds.
Some funds, for example, Tushar, maybe healthcare or something where you can still deploy a large amount of capital if it's scaling. It's more PE in that sense.
No, again, if it's healthcare, you can't. Healthcare, you can definitely, because healthcare in India is like, it's kind of like an evergreen underpenetrated sector. But if you look at health tech, for example, that tech penetration in healthcare is generally low, because today if I'm a doctor leaving out to set up a hospital, just the fact of having that real estate and setting up a hospital with the equipment itself kind of gives me business. So I'm not necessarily super challenged to build tech. Actually, it becomes harder to build tech because the core business itself is underpenetrated. So just having a hospital there kind of means कि आप loss making नहीं होगे. So you'll find very rarely कि a hospital is loss making, right? Because of that, it's very hard to, like, there are plenty of companies that try to sell like EMR and hospital SaaS, etc. But it's very underpenetrated. HMS and HIS also is very underpenetrated because it's anyway the core business.
I would say like to your point, right? These thematic funds actually don't do well in the US also across cycles because these sectors keep coming in and out of vogue, right? So it's, for example, look at Ribbit, right? Like one of the most successful fintech investors now has become an AI fund, right? So and maybe like if AI moves to something else in 5 years from now, Mickey will probably pivot to that because the asset is Mickey. It's not anyone else, right? Or it's not that fintech I'll live and die by that. It was almost heretical to think 5 years ago that Ribbit would abandon fintech as their core thesis and do something else. But they're doing it, and they're doing it well again, right?
Yeah.
So I think these thematic funds, they keep cycling out. Like they don't become institutionalized in the way you would see some of these generalist platforms become, because they don't have the staying power across cycles. and you will see the same GP जो पहले क्रिप्टो कर रहा था, फिर वो अब AI फंड कर रहा है, अब वो डिफेंस फंड भी चालू कर दिए हैं, राइट? अब वो डीप टेक इन्वेस्टर बन जाएंगे परसों, and that is like true in US also. It's not true just in India. It's
I
everywhere.
think the start off just for the fundraising bit, you need a first fund at 20-30 million. You need a differentiated value prop, so you started off that. But I think the eventual goal is for all of them to be sector agnostic, large,
नहीं,
like
आपका
large 500.
pitch, so आपका LP pitch can be कि let's say like let's say Tushar has done a lot of consumer tech, right? And he's done a lot of e-commerce businesses. So when he goes out and starts his own fund, the pitch can be from Tushar to say, I will still run a multi-sector fund, but I have expertise in consumer tech. So at least
Makes sense.
one sort of sector you can kind of, give me
Confident.
confidence.
Yeah.
कि either I'll pick the best companies and I'll also know how to run them. So I'll be able to advise the founders well and we'll create at least, a few good outcomes there. So that's the way you'll want to pitch. Ki I have some expertise, like the T thing, basically, right? Like you have horizontal expertise to kind of find out, what's good, what's bad in a business in every sector. But you have deep expertise, network, you can help source like CXOs for a certain sector. You can help understand how to align incentives, guide the founder for that, help with, let's say, a few industry connects with industry participants. But you will want to run a multi-sector fund because every sector has cycles. Abhi fintech mein ya finserv mein, let's say, abhi actually down cycle chal raha hai. So most of your fintech companies, they won't want to come to market. अब इस
Tushar,
साल
I
आप
thought you-
तो क्या करोगे? मतलब one is then you've built a team that is well balanced between portfolio management, diligence opportunities,
hard to
right?
shift. I was saying, Tushar, I thought you would say anything non-tech you would not do, given your thesis is entirely tech.
वो तो है ही यार, मतलब वो तो मैं वैसे ही मतलब I think that is by default assumed self-selected.
Your plans.
By the virtue of people on this call and by virtue of me being me. But I would also not do seed. Like I just think I find seed very exhausting. I've done it in the past and I just find it very exhausting.
Got it. No, this was super helpful,
Now
guys.
as a married man, I've got to spend some time with my wife also. So I don't think seed stage investors spend enough time with their families.
Okay, that's
Agreed.
good to know.
Yeah.
No second comments on that. That's broadly true.
Gaurav will know better, I
I
guess.
did it. That's why Pranjal shifted from elevation to Creagis.
Yeah.
Yeah.
These guys
Exactly.
never get to shut off.
Yeah. They have to be the first person on WhatsApp when the guy leaves and starts his new company or thinking of.
But the kind of stories I hear on seed, like of resourcefulness, it's romanticized and fantasized. But I then see here to what ends, and it just feels like there are.
Well, you have to
things-
love it.
There's
You have
some
to love it,
business-
otherwise it's
So
not.
you have to love the game. You have to love the game.
No, I'm just saying there's some businesses where seed is more like not a growth, but again platform creation. Like all those companies that say, one of the large multi-stage fund is putting 100 mil seed to go do a manufacturing roll-up. It's a very PE kind of a business. They call it seed because there's nothing established. They're just backing a founder and a thesis.
यार वो तो आप कुछ भी बोल लो, आप बोल लो ये पप्पू राउंड है इसका नाम, कुछ भी बोल दे, तो उसमें कोई फर्क नहीं पड़ता.
I won't
That's
call
not
it a
seed.
seed stage company. Right? Like
Right.
it's a platform play. You might call it like it's just getting started, but that's actually still investing with a growth mindset because you kind of have all your CXOs in place on day one.
Absolutely.
Yeah.
And the other thing that I don't like about seed is the fact that it doesn't scale. Every firm, like let's look at all Indian VC firms, they all started out with a seed program. Then fund size बड़ा करना था तो series A चालू कर दिया. फिर fund size और बड़ा करना था तो growth कर दिया, right?
Growth कर रहे हैं.
तो वो platform का जो expansion अगर करना है तो वो आप seed से नहीं कर सकते. Because you can't go from a 100 million seed fund to a $1 billion seed fund. To get to $1 billion, you have to add other strategies, right? Maybe seed will go from 100 to 200 for you.
Now people are doing buyouts as well, right? Like some funds have started doing buyouts in some form and shape. Some people have started doing public.
Right? So, as you keep you have to expand the platform, you have to do these things. And I feel like growth, pre-IPO, publics, they lend themselves very well to scale rather than seed itself.
No, makes sense. Thanks for the time, guys. We're already over time, but super helpful. I'm sure this is helpful for anyone entering VC, thinking about what strategies exist, how to think about some of these things. Thanks for making time. And I look forward to hosting you in some other episodes as well.
Yeah.
Thanks, Saurabh. It was fun.
Yeah.
Nice seeing you.